So we've got Taimur Baig, who's Chief Economist for India at Deutsche Bank, joining us on the show from Singapore. And of course, the rupee in focus. Taimur, the rupee we saw breach the 52 per dollar mark. It is at an all-time low as we speak. Do you believe this really warrants an intervention on the part of the Reserve Bank of India? And if in case there isn't any intervention, should we expect that the rupee is going to go to levels of possibly 58 to the dollar?
The rupee has depreciated quite sharply, no question about it. If you look at regional currencies in the last 4 months, along with the global risk aversion, there's been a depreciation of about 7% or so in the region, whereas the rupee has depreciated by about 14%, so which makes it about a 7% outlier, if you will, relative to everybody else in Asia. So in the context of the regional slowdown, India's exchange rate is getting punished a little more, and it is, of course, clear why, because of the very high current account deficit and the big drop-off in capital flows that we have seen this year. So those factors from the external account are not being helpful to the exchange rate. I don't think the RBI is exactly going to be very, very concerned with the steady depreciation of the exchange rate. I think the central bank would only intervene when there's a disorderly movement. So a la 2008, one can expect to see some sort of a major intervention. Recent studies by the IMF show that on a risk-weighted basis, India's reserves coverage is actually very healthy. So if the RBI wants, it can stop the bleed, if you will. But I think as long as it's a steady depreciation along with regional currencies, the chance of major intervention from the RBI is very small. And your question about a free fall, again, I really don't think the risk is of a free fall, but more of a slow bleed.
Right. Now, Taimur, worries over India's fiscal and current account deficits are clearly on top of the minds of investors. The rupee fall is negating any sort of fall in oil prices. Your sense of how bad things can get?
Well, again, as I just said, that the trade deficit has been a drag on the exchange rate, and as you rightly pointed out, it's not just the trade deficit that matters, but it's the twin deficit issue. The fiscal is also a problem. Now, the weakness of the exchange rate is a negative for the fiscal because India subsidizes imported fuel products, and every time the rupee depreciates, the cost of importing those things go higher. So from that point of view, the budget is, of course, looking at a perhaps 0.15% of GDP worth of downside because of the recent depreciation of the exchange rate. We will either see a worsening of the fiscal dynamic or we'll see a worsening of the inflation dynamic, because just to prevent the fiscal from worsening any further, the government might be compelled to push up diesel and kerosene prices at some point in the first quarter of next year.
Do you see this global risk sell-off continuing for a while? Just a few weeks ago, we were talking about policy rate pause and possible return of flows back to EMs. Do you hold that view?
Well, I think the Indian authorities are also sort of calibrating their policy agenda around those expectations. So, it's hard for me to see now the RBI going back on a rate hike mode, even if the inflation risks remain elevated, because the growth risks have clearly accentuated substantially in the recent months, especially with the developments in Europe. On the issue of when would capital flows come back, well, the authorities are taking some measures to help capital flow back into India. We saw an announcement about the capital account being liberalized as far as debt market investment was concerned last week. We're also hearing stories about how FDI limits on aviation sector would be raised to 24%, and there might even be some FDI allowance for the retail sector. So these will all be positive for the capital account. But as far as the portfolio flows are concerned, I think that's a function of the global risk sentiment right now, which are clearly not very positive.
What happens next in the Eurozone then, with Germany against an ECB-led bailout for economies? Do you see the contagion effect getting prolonged much further?
Our view is that the ECB is really the only game left in town now. There are fiscal issues that need to be resolved by fiscal authorities, whether they're in Greece or Spain or Italy or even France. But at the short term, the bleed in the market has to be stopped by a very large-scale intervention from the European Central Bank. But as you rightly point out, the ECB has been expressing a great deal of pessimism about its need to intervene in a very sizable manner. The fact of the matter is the sort of financing requirement countries like France and Italy and Spain have, even the UK have, for next year, these range into hundreds of billions of dollars for each of these countries. If the markets are not orderly, all of those countries will have difficulty financing themselves. And the only way the markets can stabilize now is from sizable intervention from the ECB.
Right now, Taimur, we've got the winter session of Parliament which has begun in India today. The food security bill is one item on the agenda which is going to add to the country's fiscal deficit. What's the sort of overrun that we can expect to see on account of that?
Well, the Food Security Act, even when and if it is passed, will not actually add that much to the fiscal, because it's basically replacing an existing subsidy regime with something that is a little more expansive and a little more comprehensive. So on the margin, we're looking at 0.1% or 0.2% of GDP worth of risk, and that too for 2012-2013, not 11-12.
And again, Taimur, how confidently can you say that we will see inflation down at the 7% level by March, given the currency movement, the imported inflation factor, and again, power tariff hikes, petrol price hikes, overall, prices of goods going up in India?
Not confident at all. The chance of inflation heading to 7% is not that high. It would require many, many things to work out for India. Not only the strong base effect have to work through the system, we would need flat food and fuel prices for the remainder of the year and going into next year, and we also would need significantly below trend growth so that growth impulse toward inflation is limited. One or two of those things might work out, but for all four to work out, one would have to be very, very lucky. So the risk is that inflation stays well above 7%.
Finally, when do you see the RBI pausing in its rate tightening cycle? Any chance of a rate easing to happen before Q1 of FY13?
I don't think the RBI will be able to cut rates very early, unless, of course, we have a massive manifestation of systemic risk all around the world, and growth risks accumulate, substantially. Short of that, RBI would need to see headline inflation come down to 7 or below, core inflation go below 5%. I can't see how those things can happen before May, June of next year at the earliest. So no, I don't see in January, February, March any sort of rate pause movement rate cut movement from the RBI.